You know, investing is a lifetime endeavor. There are many examples of investors who have successfully grown their portfolios over decades, only to see years of gains and savings disappear over a relatively short period. They all had the same fatal flaw built into their portfolios. The flaw is that traditional portfolio management does not effectively manage the risk that comes from spikes in volatility and from sharp declines. The sad part is that we all know that difficult periods in the markets are inevitable. And we also know that traditional portfolio theory has no answer for how to deal with them. The sole purpose of investing is to make money. But making money means nothing if you can't keep it. So when we think about it, all long-term investors have the same goal. We all want to achieve the benefits of long-term compounded returns. We want to see $500,000 double to $1 million, and double again to $2 million, to $4 million, $8 million, and so on and so forth. You know, understanding the idea of geometric compounding is not difficult, but aside from luck, achieving it in financial markets has been almost impossible. So what is the key to achieving long-term compounding? Well, you must limit the size of your portfolio's drawdowns. Now, a drawdown is the maximum peak to trough percentage decline that you've ever experienced over your lifetime. Large drawdowns can be devastating to our primary goal, which is long-term compounding. Now, I'll give you an example of the unexpected risk that's been experienced by conservative investors. Our Canterbury Portfolio Analytics Group performed a study on the recommendations from 3 automated asset allocators. They're called robo-advisors. After determining the risk tolerance from a series of subjective questions, each of the 3 automated advisors produced a moderately conservative portfolio. The recommendations were then illustrated in a pie chart, each showing the specific exchange-traded funds, ETFs, to be purchased, along with the target allocations. All 3 robo-advisors followed the traditional buy, hold, and rebalance portfolio management philosophy, which is widely used today. Now, these portfolios were then loaded into an analysis program called Portfolio Visualizer, which took the portfolios back to the beginning of the 2008 financial crisis. During that 16-month period, the 3 moderately conservative portfolios experienced, on average, a 39.65% drawdown. Now, I'm not sure how these robo-advisors would define moderately conservative, but losing 40% doesn't fit my definition, let alone it not helping us achieve our primary goal. The truth is that many of the core assumptions of traditional portfolio management have not only come under question, but have been outright debunked and discredited over the years. We've learned from decades of experience that traditional portfolio methodologies are simply not capable of managing the risks of dynamic and ever-changing markets. The advancements in technologies and innovative tools and complex software applications have changed the investment landscape forever. The successful management of a portfolio will not only require a whole new way of thinking, but a more systematic methodology that is at least as dynamic as the markets themselves. Now, the next video will discuss an evolutionary breakthrough called adaptive portfolio management. I'll also introduce our adaptive portfolio management process called the Canterbury Portfolio Thermostat. Our process was designed to limit portfolio drawdowns to about 10%, without limiting the upside to more efficiently compound returns over a lifetime.